Hello, fellow Rebel Capitals. Hope you're well. So we've got some big news as far as commercial real estate and the Donald. He is struggling, to say the least. He's struggling when it comes to his real estate in New York City. Let's put it that way. Let's get right over to this article from the Wall Street Journal. And I'm not doing this just to dunk on Trump. I'm doing this to show you, go through the numbers as to what he's dealing with one of his main properties, ironically enough, about a block away from the stock market, and just to show you a real life example of what is happening right now in the real world with real estate. We sit there and we look at all these banks that are failing or struggling, and we hear in the news that there's this problem with commercial real estate. We're like, oh, yeah, whatever. That's old news. But when you actually look at the numbers and a real life example, I think it sinks in to a greater degree as to how big of a problem this actually is and how long it's going to last. Right now, we are not in inning 9 of the commercial real estate bust. We're in inning 2 or 3. Let's get right over to this Wall Street Journal article, and I'll show you exactly what I am referring to. So the office market meltdown comes for Trump's prized Wall Street building. Now, to be fair to Trump, a lot of this is just a hit piece, just to attack his character and say that these people are moving out because they don't like Trump's policies, blah, 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 blah. We don't care about any of that nonsense. What I want to go over are the actual facts, the data, and the numbers. So let's start by looking at the vacancy rate for this building. And to be clear, it's 40 Wall. I'm assuming it's 40 Wall Street, but they're calling it 40 Wall Street is the building. So the tower's vacancy rate has risen to 21% compared with about 5% in 2015. So you might think to yourself, well, I mean, is that a big deal? He's still at 80% occupancy. I mean, so what? But when you actually look at how much he's paying in debt and what has happened to the interest rate, and then you look at the bottom line, you're like, oh, ouch. This could be a real big problem. And if it's a real big problem for Trump, in terms of this building, just extrapolate that out through the entire economy. In fact, Josh, why don't you get ready? Because at the end of this live stream, I'd like you to chime in and let us know about the conversations, the insider conversations that you've been having or overhearing with our good buddy Kenny McElroy. You don't have to give any specific details or names or anything like that. But just so you can give us some anecdotal evidence as to what you're seeing, they're hanging out with one of the best in the business as far as real estate, and that's Mr. Kenny McElroy. But let's get back to this article here. So this is a drugstore chain, Duane Reade, which is probably their key tenant, one of 40 Wall Street's largest tenants. There you go. Recently vacated its office and retail space in the building, leaving 23,000 square feet empty on the ground floor. And this isn't just, and as you can tell by Duane Reade leaving, it's not just about office space, right? Duane Reade doesn't have employees that are coming into the office and that are now working at home via Zoom or something. It doesn't work with a drugstore like that. Most likely, they're just probably getting robbed blind. They're getting robbed to the point where they can no longer make profit. And who knows what other crazy things are happening to them in New York. So they're like, look, we can sit here and just be the victim of theft for the next 5 years and lose money, or we can just bounce and just go somewhere else where there's actually rule of law for the time being. So this is a really interesting chart, the availability rate. So out of the total capacity for New York City, this represents the amount of space that's available to rent at any given time. So we can see back in 2015 or so, right around 12%, 14%. Goes down 2020, to a low of, boy, just barely over 10%. And now it's shooting straight up higher, like we said, almost at 22%. And the question is, what's the catalyst to this going back down? You got me. In fact, my base case is that it would continue to go up, especially in New York. And by the way, we're focusing on Trump in New York, but this is going to be a story that you're going to see play out everywhere, even in the red states, like I want to call it Arizona. It's kind of purple. But even if you want to look at the states that are getting all these inflows from California, from the East Coast, from the Oregons and the Washingtons of the world, it's not like you can sit back in Texas or in Florida and say, well, this isn't something that we need to worry about because it's not going to happen here. No, it is. It is. Just wait for it. And even if it doesn't, it's going to impact the banks, which will in turn impact the local economy. Trump faces a bigger reckoning for the building next year. Here we go. This is where the stuff is hitting the fan. And by the way, this is why I say we're probably in inning 2 or 3. Definitely not in inning 8 or 9. Because a lot of this debt hasn't come due yet. And there's a lot of shadow inventory. I talked about that with my good buddy Kenny McElroy last time we had him on this channel. And what that shadow inventory is, let's just go back to these numbers for Trump. And they say, well, now he's at basically he's gone from a 95% occupancy down to 80%. Right. But how many of those tenants that are still left are even in the building? Right? Just because he's got an 80% occupancy rate doesn't mean that the tenants that are left are utilizing the space. They could just be riding it out. In fact, a lot of them probably are just riding it out till the lease expires, and then they're not going to renew because they don't need the space anymore. But they're not going to stop paying mid-lease because a lot of the tenants probably personally guaranteed it or whatever it is. So this is what I'm talking about in terms of shadow inventory. So you have to look at an occupancy rate and take it with a grain of salt, understanding it's most likely way overstating reality when these leases expire. And then on top of that, you've got the problem, like we were just going over, with the debt coming due. It all doesn't come due at once in 2023. Some of it, a little bit in 2023, more of it in 2024, a lot more of it in 2025. And then by the time you get to 2026 or so, most of that debt, because it's short term, has already gone through that process. Remember, when you're taking out debt on a giant 40-story, whatever it is, commercial building, it's not a 30-year fixed rate loan. No. These are loans that might be 3-5 years, something like that. So that makes all the difference in the world. But getting back to his specific mortgage, $120.5 million. This is due in July. So, and you say, well, George, the building must be making a lot of money. Yeah. Wrong. And then even if it was, it's not even coming close to being able to pay this debt. So that have to come either out of pocket, or maybe he can sell some Truth Social. or what he's going to have to do is roll over the debt. But that becomes an even bigger problem. More on that in just a moment. Actually, we're going to address that right now. So if he is able to even roll over the debt, and that's not a given, he's going to roll it over at what is likely to be about 7%. And this is assuming that he can get a market rate as it is right now. That would be roughly double the 3.7% that Trump pays today. So I did some back of the napkin math here. And right now he's paying about $4.4 million per year in interest. Okay. So if he refinances and it goes up to 7, now he's right around 8.4 million. So an additional $4 million per year just in additional interest. This doesn't include the increase in insurance he's likely had. This doesn't include the insurance and taxes. This doesn't include the insurance on the cost just for maintenance, just to keep the building up. I mean, I don't know why I'm saying this is a 40-story building. It's probably because it's 40 Wall Street, but let's just assume for a moment it is a 40-story building. This is not like a single-family home where just every week you have to go out and mow the lawn. I mean, this is a massive project. I can't even imagine how many full-time employees are working on a building like this just with maintenance every single day. So those costs are going up as well as everything else, while at the same time your occupancy rate is going down, and to a degree to which you don't even know unless you went out and surveyed all of your tenants and said, hey, by the way, you guys, your lease is expiring in a year or two. Do you guys plan on staying? Yes or no? And my guess is a substantial percentage of them would say no. So there's little Trump can do to stem the mounting distress in the U.S. office market, which has been intensifying as more companies accept hybrid work, reduce their demand for office. The office meltdown is reaching new heights as defaults and other signs of distress reach historic levels. The vacancy rates at record highs and hundreds of millions of dollars worth of debt coming due in the coming years. The prospect of significant losses is sending tremors throughout the financial system. And this is not George Gammon, the economic version of Alex Jones and the tinfoil hat and doom and gloom and fear mongering and all this. No, this is the Wall Street Journal. Just count it like it is. I'm not putting words in their mouth, not using hyperbole. Right from the Wall Street Journal, they're talking about the prospect of significant losses sending tremors throughout the financial system. And remember, that isn't just applicable to commercial real estate. That impacts the banks. And even if you want to argue, well, that's just the regional banks. No, because that increases perceived counterparty risk. And if the risk goes up, even with the big banks, what happens to the liquidity? It goes down, regardless of what the Fed is doing. And by the way, if liquidity goes down in the banking system, in the monetary system more broadly, then that just puts further additional pressure on commercial real estate, and then it becomes this doom loop. They say the slowdown in New York's financial district also doesn't bode well. The downtown Manhattan availability rate, okay, we talked about that earlier. Oh, here you go. Look at this. The average rents, the average asking rents have fallen to about $57 a square foot from more than 65. So this is what you see in a deflationary bust. And you can say, George, prices are still going up. They absolutely are. I totally agree with that. As far as what you're spending at Walmart and putting gas in your car, putting a roof over your head. But we have to acknowledge that there's going to be a lot of prices, or at least downward pressure, coming on prices in other areas of the economy that could negatively impact unemployment, which would lead to a decrease in aggregate demand, which would then put pressure, downward pressure, on the things that you're buying. You say, well, that's great. I need prices to come down. Well, not at the cost of you losing your job. Even Trump acknowledged in his deposition last year, New York office market has unfortunately gone to hell. That's a direct quote. And I would guess that if you took a poll of the majority of the real estate guys and gals throughout the country, especially the ones that are dealing in office, they would, in fact, now it's even multifamily. And we'll get into that in a moment here when Josh tells that story of Kenny, but they would say the exact same thing Trump's saying. Here you go. Now let's go over some of the real numbers that matter. Commercial property appraisers rely more on income properties when determining the value. Using this approach, they say 40 Wall Street is worth between about 120 and 200 million. And again, that's with an 80% occupancy rate that doesn't include the shadow inventory. Depending on whether bullish bearish multiple is applied, it's an annual operating income of about 12.8 million. So remember, that's 12.8 million of operating income for the entire building, with an interest rate that, or an interest expense, excuse me, of 4.4 million. So let's just say everything else is equal, and let's just give them the 80% occupancy rate. Okay, fine. Well, now what happens when the interest expense goes up by 4 million? Well, that would decrease this operating income, or it would take it from 12 million down to 8 million. Okay, well, if the operating income is only 8 million, now you're using that on top of the multiple to determine the price. Well, if the price is, let's say, 120 million with 12 million a year in basically profit, if the profit goes down to 8 million, your building ain't worth 120 million anymore. But let's remember that this debt payment that he has coming up is 120 million. So how on earth are you going to get a bank to give you the 120 million when your building probably isn't even worth that much? You see, so even if you could get the 7% interest rate, even if you could handle the 7% interest rate, you might not when the bank actually looks at the financials and then determines whether or not you can handle the interest rate that would be included with that rolling over the debt. And basically the article states this almost word for word. The few lenders willing to make office loans, period, not just to Trump, but anybody, the few lenders willing to make office loans today typically require the building value be roughly double the amount of the loan. So that'd be 240 million. So that ain't happening. We are seeing office loans that are performing much better than 40 Wall Street having trouble getting refinanced, which makes sense, which makes all the sense in the world. And that's according to Melissa Chi, a Fitch senior director. So again, I'm not sitting here dunking on Trump. I'm just using this as a very specific example so we can go through the actual numbers to determine what real estate investors are dealing with across the country, and therefore how that will impact the banking system, how that will impact liquidity, and in turn, how that will impact the overall economy and the unemployment rate. So Josh, again, you don't have to give any names or anything like that, or any specifics.
I definitely can't do that. But there's a lot of stress in multifamily, at least large multifamily.
And so you've been hanging out with Kenny there.
Yeah,
and you've been listening to a lot of the conversations that he's having, a lot of the phone calls that he's taking. And the bottom line here is Kenny is taking calls nonstop from, let's just call them distressed landlords.
Yeah. Well, one of the deals that he's looking at right now, I know that they built it for about 300,000 per unit, and they're going to sell it for 220. They're trying to get it off their books.
And they still can't sell it at 220.
Well, no, Ken's bidding on it for 220 because if he wanted to build it, it would cost him 300. So he's getting something that's going to be incredibly positive cash flowing, which 2 years ago, it wasn't possible. So you're just now starting to see those types of cracks. But he says the reason why he thinks this hasn't happened sooner is because a lot of the people who were in that position where they were kind of going bust, it went back on the bank's balance sheet. But what the banks did, they said, we're not going to take a loss on this if we don't sell it. So let's just manage it. And so there's a lot of banks who are managing these properties, but Ken said the hardest
that are upside down, and they're just waiting for interest rates to go up so they can get a better deal. But if those, even if they're waiting for interest rates to go down so they can get a better deal and maybe get out of it unscathed. But we know that even if interest rates do go down, that most likely means occupancy rates go down, and they got to be careful what they wish for, because that could put them in an even worse situation.
And the bigger problem is if they don't sell, they don't take a loss on their books. So, so they don't want to show that they have stress on their balance sheet, because then, as you were saying, the liquidity goes down, which is the main problem within these interbanks balance sheets. So they're managing a lot of properties, which is what they do not want to do. The banks do not want to manage these properties, and that's the hardest part of buying. So they're in a pretty difficult situation where the loans that they have are just wiped out. And so they're managing not great properties because they made bad loans on them.
Yeah, and properties that are negative cash flowing. So we know that that can only last so long. I mean, they're kicking the can down the road, but at some point they've got to wave the white flag and say, we got to sell, and we're going to take pennies on the dollar, in which case that's when Kenny comes in. But the main point here that we're trying to make is Kenny is fielding more and more and more of these calls from investors or banks or whatever that are in absolute dire straits.
Yeah. So he's loving it. Ken's just super excited every day because he wasn't buying anything because the math didn't work. But now it's really, really starting to see a ton of distress. So he's like the shark that everyone's just going to, and it's his terms. It's really
I mean, it's great for Kenny. It's bad for the economy.
Everybody else, yeah. But it's good for renters because rents are most likely going to go down.
Rents in those office buildings, or
even multifamily.
Oh, right, because Kenny's specifically dealing with apartments.
Yeah. So multifamily rents are going to go down. They already are in a lot of cases. So that's a lot better for people who are renting, which is, I mean, overall better for the economy.
And what's interesting about that is how does that play into the CPI?
Yeah.
Right. Because the CPI, like 33%, is owner equivalent rent. So I'm not saying that they can accurately judge rent by the way that they collect the data. But if we do see that owner's equivalent rent start to go down, that's going to be a huge drag on the CPI, at least that headline number, which doesn't really matter for the normal person, granted, but it does matter for Fed policy.
Yeah, that's a good point.
Yeah. All right, buddy. Thanks for that input. Guys, enjoy the rest of your afternoon. I want to remind everyone to get your tickets to Rebel Capitalist Live ASAP. It's going to be one of the best events, one of the best conferences you have ever been to. I can assure you of that. Is May 31st, June 2nd, Orlando. You can go to rebelcapitalistlive.com, check out all the speakers, the VIP guests, and you can get your tickets ASAP. So I will see you in Orlando at the end of this month, and I'll see you on the next video.